Are there any other sort of like wild card moments that happened in the exit process, in any of them?
Great businesses have great exits. If you build a great business, it's growing rapidly, is creating value and is unique and differentiated in a way that's defensible, you'll have a good exit. As you're thinking about an exit, it's better to sell too early than too late. Don't be too greedy. I would try to sell between like 50 to 75% of where you're highly confident you could get the business from a revenue perspective, because what if you miss that and you flatten out? And once you hit that plateau, it's really hard to convince investors that you can turn the growth around. As a founder, you should place a premium on a clean deal. So like if you can get cash versus equity and upside and all that, like take the cash, even if it's lower than the equity, because the likelihood of that equity ever being worth anything is really low.
Hello, everybody. Welcome to the latest episode of High Stakes. I'm Paige Soya, managing partner of K Street Capital. And today we have Aaron Mendez with us, who is actually one of our more recent and one of our most exciting portfolio company investments. Actually, I think we recently closed this deal back in like April, May. And I know usually we have guests on here who have been founders we've invested in for a long time, or investors that we've worked with or invested with for a long time. And this is really cool because we're getting to hear the journey of one of our most recent and current founders in our portfolio who's had a ton of exits. So I will stop there. And Aaron, maybe if you want to just introduce yourself, and then we'll get into some of the exits.
Yeah, sounds good. Thanks for having me on, Paige. And super excited to have you guys as investors in our company. So yeah, quick intro to me. I've been involved in tech startups either as an angel investor or a founder or part of an officer team for over 20 years. I've seen a lot. I've had some successful exits and some kind of base hits and some downside exits. So I think I have a lot of interesting insights that might be useful for founders. What I'm up to right now is I'm the CEO and co-founder of a company called PrivacyHawk, which is a consumer tech company that helps protect people's personal data from falling into the wrong hands. It's a subscription service we call personal data protection, and scans to find out where your personal data is exposed, which basically puts you at risk of spam, scams, and identity theft, removes those exposures and continually monitors for new ones. It also has identity theft protection and insurance. So it's really a full suite of tools to help keep your personal data safe and reduce your risk of spam, scams, and identity fraud. We have grown pretty remarkably. We just put out a press release. We grew 1,100% last year. We have over 1 million users, over $4 million revenue run rate at the moment, which is growing by like $500,000 every month. So yeah, we're having a lot of success right now. And I think it's because what we're doing is important to people. Protecting people's data and privacy has become, paramount. Our personal data is central to who we are and our identity, and also can be used for very dangerous, nefarious things. And so people recognize the need for something that automatically protects them without them having to do a bunch of work. And that's what we do.
Awesome. Thanks, Aaron. And I also think it's worth saying, you've been a founder and an operator, and in digital marketing and data and other things. You've also been an investor. So I don't know. I think this episode will be interesting, not just to the founders, but also to other angel investors or anyone that invests in venture, given that you've had so many investments. You've seen it from both sides of the table. So I think this will be fun. So where should we start? I was thinking maybe the two more like major exits that you were more intimately involved in when you were at the company is like one of them, I think, was your company, Quantio, right?
Mm-hmm. Yeah.
So let's talk about, maybe give a quick summary of that one, and then we'll talk about a little bit about 1010 when you were there.
The stories are intertwined. So Quantio was an e-commerce analytics company. It was kind of like Nielsen for e-commerce. So Nielsen measures TV ratings and like grocery shopping and stuff like that. 10 years ago, there was really no service out there for e-commerce that was measuring like what are people buying, what are the trends, what are the sizes of different markets. And e-commerce was growing like 10 times faster than regular retail. And so we saw that as an emerging market. And we were actually, it's funny because one of the reasons that I started PrivacyHawk is because I used to be on the other side of this world where we would collect and harvest data from users on their behavior, which was very valuable to brands and marketers. So I was buying a lot of data from data brokers and also creating a lot of data with large user bases. So I kind of got a sense of what's going on with our data behind the scenes that most people don't know. So we spun out Quantio out of another company that had tens of millions of dollars exit called Sturkley Media, which we grew from $15 million revenue when I started. In 12 months, we got to $65 million in revenue, and we had 50 million monthly active users. And we were thinking, wow, we're able to see all the browsing behavior of these users, because a lot of our users were mobile apps and browser extensions. We're like, this data is probably really valuable. We should start building a database of measuring what people are doing online. So I pitched the board of Sturkley on spinning out a company that just did e-commerce data analytics, and that was called Quantio. And so they invested several $1 million in the company, and we built a team of about 13, 14 people. And we were in the process of raising a seed funding round when that company hit financial hardship and was not able to continue investing in us. And so we kind of had to do a crash landing because we had no more funding. So what we ended up doing was looking for a strategic acquirer. And we were talking to some very big companies. In fact, Nielsen was almost acquired us. We were talking to IRI, which is Nielsen's biggest competitor. Both of those companies are multi-billion-dollar companies. And 1010 Data was very interested because they had a consumer data business as well, and they thought that what we were doing was very complementary to what they were already doing, and that they could just like plug in the data and the products that we had into their existing customer base. So that was an interesting acquisition because it wasn't like a great outcome for anyone, because it was a downside acquisition because our investors were no longer able to continue funding the company. And we couldn't afford to, none of us had the money to continue financing the company. So we had to sell it. And it ended up being kind of like an acquihire, and it ended up getting kind of contentious. And I think this is one of the lessons for founders is you need to make sure that you're aligned with your investors, both in an upside and a downside scenario. A lot of times investors get something called preference, which is you have to sell the company in kind of like a liquidation scenario. Investors get all the cash back that they invested first. And that's a good deal. A lot of times they get 2 or 3 times preference, which means if they invested $1 million in your company and you sell the company $2 million, they get the whole $2 million, you get nothing. A lot of times what happens is if a company does want to acquire you in a liquidation scenario, they also want the team. So the team can kind of land with jobs and maybe some upside in the new venture, but they don't get any cash. That's the most common downside scenario in a startup, is that the investors maybe get some of their money back, maybe 1 times back if they're lucky, but they usually probably get less than what they invested back. And the employees get decent paying jobs at a bigger company and some upside. And that's what happened with us. But it got very contentious because we had shareholders that were more emotional about the principle of getting a good deal versus what was best even for them or for us. During the negotiation, so we didn't have an agreement on preference or anything like that, but they basically said they were going to block the deal unless they got all the cash. And they were like, well, you guys are getting these high paying jobs and all this upside or whatever. And we're like, well, why don't we split the cash and split the upside? And they were like, no. Right. But they said, we're going to walk if you guys don't give us all the cash. And so they kind of forced us to do that. So we got acquired by 1010 Data. The team, we all worked there for several years. We had an earnout. And this is another lesson for startups. If you do get acquihired or, have a small acquisition with an earnout, there's some things that you need to put in place to make sure that incentives are aligned so that you can actually hit that earnout. Typically, earnouts are very aggressive. Like they want you to get to like tens of millions of dollars in revenue, and then they'll give you like a small percentage of that, or like maybe like 10% of it or something. But you have to think, okay, what's it going to take to actually get to tens of millions of dollars in revenue? If there's just a team of like 5 or 10 people, are they going to invest in the business? Because if they don't invest, it's not going to hit its targets. And so if you can, you want to try to negotiate upfront some like commitments from the company to the business so that you can hit those earnout numbers, because otherwise you're going to miss them and then you just have a job. Make sure you're thinking about that when you're if you're in a situation where the majority of your upside is on an earnout, make sure that you have a commitment of resources from the company to hit that.
We just did an episode on this exact topic with someone who didn't do that, and it was a total disaster. And basically, they changed a bunch of the terms, including cutting their salaries to half. Right?
Oh my gosh! Yeah.
Not only were they not, providing the resources that everyone had hoped but didn't get in writing that they were going to provide, but then on top of that, they were cutting people's pay, and it's like, okay, well, I still have to stay if I want to see this through, and it's just disastrous. But I want to go back for a second to the acquihire, because we do see this sometimes, but not as often as you might think, but it happens all the time. Like, it's very common. And one of the things we always talk about is like, how do you value an acquihire? And I'm curious if what you're willing to or able to share about the valuation of the business when it did sell. I know it was a down round, but what were they looking for, and what were they, how were they valuing it? Or did they just value it and sort of provide employment agreements?
The valuation was employment agreements and cash out to the investors. And it was, the cash out was a little less than $1 million. And then, the value of the employment agreements was a lot. I mean, there was, when Strictly cut our funding, 7 people out of the 14 had to go get jobs. 7 of us stayed and said, let's commit to 6 months, try to turn this business around, raise some VC. And it was just taking too much time to raise money. So we were having venture capital conversations alongside acquisition conversations. If the employment contracts were several $1 million, because we were all relatively expensive senior engineers or salespeople. And then there was the earnout, which had the potential for millions of dollars for each of us if we hit certain numbers. So it's like, how do you value that? Yeah, we didn't have much revenue. This was really an opportunistic acquisition. Okay. We had 6 paid pilots with big brands. We had Hewlett Packard, GoPro, Johnson & Johnson, a few other like big CPG brands. So we're like, okay, there's something here. Companies are willing to pay 6 figures a year for this kind of data. But we were doing these small paid pilots of like $25,000. So we had like $150,000 in revenue. So okay. We were basically, but 1010 Data was very confident that they could turn this into tens of millions of dollars in revenue within like 2 years. So for them, it was like, hey, these guys have a proprietary data asset that's very difficult to reproduce. We had millions of users in our panel that were able to track all their browsing behavior, which is pretty hard to do, to get that. And then we had this talented team of engineers that were very experienced, and they had a business that was already selling kind of an adjacent kind of data that they could just bolt this into. From their perspective, they weren't acquiring revenue, they were acquiring a data asset and a product that was ready to sell into existing customers.
Makes total sense. And how did that go on the 2-year period of what they were hoping to grow it to?
We missed every earnout number.
Brutal.
Yeah, I mean, they did invest. I'm trying to think of how to characterize it, because they invested millions of dollars in the business. They helped us grow it. They contributed team members. Ultimately, I think what made it so hard to hit these numbers was they had their own technology stack, that older technology that was much more difficult to develop on, and kind of tried to put a square peg in a round hole by taking our tech stack, and they wanted us to like rebuild it in their tech stack, which was an inferior tech stack, and it was really dated technology. And it took us a long time to try to get it to work in that tech stack. And in the meantime, the sales team didn't have anything to sell. And next thing you know, a year or two had gone by, and we were at about 60% of where we needed to be to hit that first earnout number. But we still had really good jobs. We got great experience. It was a great culture. There was a startup culture company. They were growing rapidly. And while I was there, I became the head of all data products. So I was the VP of product there. And so I was overseeing more than just our business, but all of our data products. And so I was very, very senior in the company. And there was like 300 employees or something like that. And we got acquired for $500 million. And so I was able to be part of that exit and get to see that whole experience, and that was a good outcome. They got 10x revenue multiple on the acquisition, which back in 2014, a $500 million exit was pretty substantial. All the founders made, life-changing money. They had been working on the business since the late 90s, so it was not a quick exit. They got acquired by Advance Newhouse, which is a $1 billion family office that owns Nast, which pretty much owns like every magazine and newspaper that you can think of, whether it's Vanity Fair or Wired or whatever.
Yeah.
And then they owned at the time a third of Discovery. They owned Bright House Cable, which was in the talks for some $6 billion merger with Comcast. They also own Reddit, and they still own, I think, part of Reddit. And this was, they were looking to get into enterprise technology as a diversification, and they bought it for $500 million outright, which was pretty rare. I was talking to the CEO recently about that acquisition. He said, as a founder, you should place a premium on a clean deal. So
Exactly.
like if you can get
Great
cash versus equity and upside and all that, like take the cash, even if it's lower than the equity, because the likelihood of that equity ever being worth anything is really low. And so try to get a clean deal if you can and prioritize that, even if it's maybe a lower valuation than another deal that's less clean.
100%. Yeah. We've seen too many of those go very differently than, even with some of our early angel syndicate investments that were like exits theoretically, but then we didn't get cash. Maybe we got 50% cash up front or something, and the other 50% was coming plus some on earnout.
Yeah.
And, then, slowly that deteriorates to much less than you would expect. So they always get you on the earnouts. Yeah.
These days, it's really hard to get an all cash deal. I mean, you have to have an enormous amount of leverage and be dealing with a big company like Microsoft that just has tons of cash. If you're dealing with like a private equity firm or maybe a mid-sized company,
it's never
you're not going to get all cash. A lot of these mid-sized companies don't even have that much cash. Like, you could be talking to a company that's got like 500 million in revenue. They might not even have 50 million in cash.
Exactly.
So, you're talking to a $500 million company. You think they're going to buy you for 50 or $100 million with cash? No way. There's going to have to be some sort of equity component.
Totally agree.
Yeah.
So, and then did you feel like, since you maybe didn't hit the earnout targets, but you had equity as part of the deal, like you and the other all seven of you as part of the acquihires, so I assume that equity ended up being worth something in the transaction shortly thereafter.
We did have some. It wasn't life-changing, but it was, low six figures, not nothing. Actually, something that the founders did that they didn't have to do, which was really nice, was they vested all the employees, and they didn't have to.
I was going to ask, because it was only 1 year, right? Or a year and a half after you got there. Yeah.
They were very, very compassionate with their employees, and were not kind of greedy and just like take everything for them. And like I think they personally gave up money to vest all the employees.
Yeah. That's awesome. You don't see that every day.
Yeah. I mean, it was such a big outcome for them. I mean, there was two co-founders that owned the majority of the company. So,
yeah, they were bootstrapped, and they didn't have a lot of investors, I assume.
Yeah. They did do a growth equity round with Norwest, which is a very big growth fund in Silicon Valley. I think they had a pretty good outcome on that investment.
So what was the length of the exit time, like process from start to finish with when 1010 went through it when you were there?
Yeah,
I'm curious how involved you were as a senior sort of like VP of product at the time.
I wasn't super involved, other than asked to kind of prepare like projections and kind of upside potential of various like markets and product lines and things like that. But it was kept very close to the vest by the founders, and they were working with a large investment bank to run the process. They had started having conversations. So when you're growing, once you get past like 10 million in revenue or even 5 million, like we're at 4 million in revenue now. I'm already getting companies reaching out to us about potential acquisitions. Tends to be a cognitive dissonance in valuation at this stage. But as you get later, people reach out to you. Someone can tell when a company's growing. They can see you're hiring or whatever. So they were starting to have these kinds of conversations, but they started having more serious ones towards the end of 2015, I think it was. Once they started having those conversations, it moved pretty quickly. I think probably the whole process was like maybe 3-4 months.
Okay.
And they got lucky in the sense that they had an acquirer that was motivated to buy and had the cash to just write the check, which is, and they didn't have a lot of legal bureaucracy because it was a family office, not a big company like Microsoft or Cisco or something like that. So it was a very fast, very clean deal for us, which I think is pretty rare.
Definitely. Yeah.
Yeah, it was a great outcome for everyone.
And what about the timeline with Quantio and 1010 from the moment you sort of started? I know you were sort of, I guess you were simultaneously fundraising and considering acquisition, but maybe once you started conversations with them.
Yeah, that one took about 4 months, and a lot of it was the negotiation with the existing shareholders. I made a lot of mistakes with that business as far as just setting it up for success, particularly with the cap table. So one thing that you have to be careful about early on with a business is that you have a clean cap table, because nothing will kill investment or acquisition faster than having dead weight on your cap table or conflicting interests on your cap table. We had both. So this was a lesson that I will never make this mistake again. You cannot have dead weight on your cap table, particularly if they own control. So our situation was we had spun out this company and they were investing pretty heavily, and everyone was getting like a full market salary with some upside in the business, but they owned, like 60% of the company.
Oh, wow. Okay.
And they weren't able to continue investing in the company, so they pulled the funding. And so our option was, hey, we could have said, well, we're just going to walk then. We want controlling, we want like 90% of the company. You'll be lucky to get anything since you pulled your funding. Or we could negotiate with them and maybe see if they could give us a little bit of money just to keep the lights on, because we had some fixed overhead even if we weren't going to take salaries. And I think I underestimated how much leverage we had, and we ended up going like 60-40. So I forget how much they owned. I think it was like I don't know, 60 or 80% or something like that, and they agreed to invest as individuals, which was nice of them to do, $250,000, which was a lot of money. I think 5 people wrote like $50,000 checks or something like that out of their own pocket.
This was in the last funding, right when the companies wanted to stop funding the business.
And they said, well, we've already invested $3 million. We think that's worth 40%, and then we'll give you another 250 out of our own pockets for another 20. So we'll own 60%. You guys have 40. And we're like, well, I guess that's not unreasonable.
Oh, no.
I didn't know that having an outside entity owning the majority was like a poison pill for VCs. So
totally.
Like we actually had some investors that were willing to put in like a couple $1 million into the business and finance us. And they said, but only if your investors cram down to like 5 or 10%. It's called a cram down. And our investors said they'd rather have nothing than the indignity of being crammed down, which was wholly irrational. And they stood their ground and they killed the financing round. And that was super frustrating. And it forced us into this acquihire scenario. They probably would have had a better outcome because we could have done a lot with that $2 million.
Yeah, I mean, in theory, you could have just walked away. They've stopped funding it if they didn't give you the 250. You could have probably found another investor. Maybe not at the time. Maybe you didn't have that investor network. But like, you could have this round you're talking about right now. Maybe you could have pulled in at the time, and they would have been gone. They would have been only 40% or less at that point, and you'd have new financing. And who knows
Yeah,
where
like I said, I made a lot of mistakes. I was very naive back then. Didn't know a lot about a cap table or like what is important to investors. I didn't know leverage that we had. I didn't know that it was an option for us to just walk away and maybe kind of spin up a new business and just kind of do the same thing, take our clients with us or whatever. We were in shock because we were being financed really well for a year, $300,000 a month from this business, and then all of a sudden, overnight, just out of nowhere, without any sort of warning, they're like, "We can't finance you anymore. You guys are all basically on your own." Like, right, and so, we were in shock, and we didn't. We were kind of not sure what to do, so we ended up just kind of going with the flow versus fully understanding what our leverage was. But yeah, I will never make the mistake again putting this dead weight on a cap table. It's better to just walk and start over.
100%. Were you you were the founder CEO in that company?
Right. Yeah.
Yeah, and wasn't that was that your first founder? Well, not your first founder role. Maybe you were co-founder of a few other things, I think, but that was your first.
That was my first founder role where I was like in the driver's seat, and I started it and was, the sole like founding CEO. I mean, I did have co-founders, but it was my idea. I raised the money. I had done a couple of smaller things. I founded wellness.com, which we got to like 3 million revenue run rate. But I did that within another company where the CEO was very entrepreneurial and he owned wellness.com. And I was like, I want to do something with wellness.com. He's like, all right, go for it. And so I started building it out, and he started giving me engineering resources. Then I also founded a company that could have been what is now known as Thumbtack. It was basically like a talent and skills marketplace. It was called Skillwho. Ahead of its time, we started this back in like 2006, and it was a social media platform where individuals could go on and list their skills, and you could find out who in your social network had different skill sets. Like, hey, I need an accountant, or I need a lawyer. Oh, knows a lawyer or whatever. That I sold to Sterkley for $1,000. So that was a tiny exit, but yeah, nothing. Yeah.
I mean, it's nothing in most exits, right? So I think any cash is good. Is a good situation. But the reason I ask is because if this was your first like founder CEO really role, it's just like I always tell people, don't beat yourself up about it because there's so many mistakes that everybody makes the first time they do this.
Yeah.
Like
when I tell people, oh, sorry, go ahead.
I was just gonna say, when I had my company, same with the cap table thing. I had no idea. Like this was my fintech company. I had raised like 500K in convertible notes or something from angels mostly. We were going to our next round, and one of the first investors we talked to was like, "Can you send me your cap table?" And I was like, "Yes, absolutely." And I hung up the phone, and I was like, "What is a cap table? What do I need to do now?" Like I didn't even think that was something I needed to ask for. Even though I had worked in finance before, I fully knew what cap tables were, but not in the context of like this sort of situation, versus like a public company. So anyway, you were saying.
Yeah, I like to say I have a lot of success stories, but over the last 20 years, I think the most valuable things are 50 mistakes that you should not make with a startup. Those lessons you learn them early on, and then you don't make those mistakes again in the future.
You never learn the lesson better than when it happens to you.
Yeah, exactly.
That's for sure. Okay, only a couple more questions because I don't want to keep you forever, but are there any other sort of like wild card moments that happened in the exit process, in any of them? Also, this can include some of your angel investments that exited, as an investor, just things that came totally out of nowhere that you weren't expecting.
Well, we weren't expecting the investors in Quantio to be so unreasonable during that whole process. I think the people can get emotional and irrational in downside scenarios when there's money loss involved. And so one thing that you want to choose carefully about your investors is that they are not overly emotional, or I guess make sure that you feel like your investors in a downside scenario would be rational versus emotional. If you have influential investors on your cap table that have the potential to get emotional, could derail things. Choose your investors carefully and think about it like, okay, I'm on an airplane that's crashing. We need to crash land it. Who do I want in my co-pilot seat with me?
Exactly. Yeah, I always tell founders if they're thinking about taking investment from us, like they should do their diligence on us, like talk to some of our other founders and see how we've reacted in certain circumstances so you can decide if it's the right, if it's the right fit for you.
I also would say that, and this is more on my angel investment side. Actually, it was also at Brandable, which is the company that Justin, my co-founder, and I worked at. That was another interesting crash landing because that company was doing 30 million in revenue, and within 9 months, ran out of cash. The CEO was not great at managing cash. I had already left the company because it was in LA and I was commuting and it was too far from San Diego. But both scenarios, the founders waited too long to tell their investors that the company was in trouble. I've had a number of angel investments where even the lead investors were like shocked to find out that the company was like weeks away from running out of cash. Tell your investors early. They're incentivized to help you.
Thank you. So true.
Investor in our seed round, FFVC, who's invested in all three of our rounds. They've been super supportive, and tell John, who's on our board, John Frankel, a year in advance of things that I'm worried about. And helps me walk through it. Like I was worried after we closed our seed round last year, we raised $1.7 million. And after legal fees and a bunch of other, a few months of burning money or whatever, we only had like 1.2 million left, and we were burning like 100,000 a month. And I called up John and I was like, I was hoping we had 18 months, but we only have 12. And then he helped me navigate that situation way ahead of when it was going to come to a head.
That's
and so go ahead.
No, I was just going to say, wearing my investor hat, that's my absolute favorite thing you've said this entire episode, because there's nothing we can do to help you when you tell us 2 weeks before. There's nothing we can do. Like we can try to make introductions or whatever for you, but no one's going to take it seriously. You're already in the situation. It's too late now. But if a year in advance or even 6 months, then investors, like you said, are incentivized to help figure that out and be thinking about who are the right. What's the right capital stack for you if that's the route to go, or how do you want to operationalize the business to make it work on the cash that you have, but then you have time to do that and make those changes and see the effects of them. You're never going to see the effects of any changes in 2 weeks. So anyway.
It's very important for founders. You don't be embarrassed. Don't have any ego. Don't feel like you always have to be giving your investors only good news. Like, their job is to help you, and if you don't give them the truth, they can't help you. And it's not like they're gonna into you or try to take control over the company. They're gonna help you. They're not in a position to take over your company. Like none of my investors could take over PrivacyHawk. Like they don't know what to do.
Exactly.
They're not gonna try to replace you with another CEO. By the time they find the right one, and then have that person, learn the business, it's gonna be too late. They have to work with what you have, which is your existing cash, your existing team, your existing situation. They're going to help you. Most cases. I mean, there could be scenarios where you have an investor that's not helpful, but in most cases, particularly with like a legitimate VC fund, be honest with them, and as early as possible, if you're seeing potential, even like things that are low probability of happening. And this is another thing that I talk with John Frankel about all the time. I'm like, what if this happens? What if that happens? It's probably not going to happen, but what's our plan if it does? And we talk through that stuff so that when we have black swan events, we have a plan and we're getting ahead of things. So definitely leverage your investors early and don't feel embarrassed to talk to your investors about problems that you're having.
Plus, like, just for this should be the reason, but it is a benefit for your own mental health to do that early and often. As a founder, not carrying it around inside, thinking about how you're going to have to try to solve it. to continue, giving good news or selling a story that isn't the reality of, and you've got all these fears that you're just sort of like holding on to. I think the more open and honest and early you are about that stuff with the people who are stakeholders in your business, the faster you're going to get it resolved. Or then if it does take that turn and it really does go sideways, it's not a surprise to anyone, right? Like you don't feel like it's the end of the world because you already kind of have accepted the possibility of this and tried as many ways as you could to solve it and brought other people in to help you. So that's how I feel about it anyway. Cool. Well, I guess I will say there's so many more questions I could ask you. I didn't even know half of these stories, so thank you so much for sharing them. I guess I'll just say any final thoughts or final takeaways or funny stories that you want to share.
There's a few things that I wrote down that I think are important when you're thinking about exits that we didn't get to talk about. They're just like quick little anecdotes.
Great. Let's do it.
So one of them is if you're thinking about your exit opportunities, you have to think about the types of buyers. There's technology buyers, there are private equity buyers, there's EBITDA buyers, and there's revenue buyers. And they each value companies differently. And you're going to see very widely varying valuations. But a lot of companies that you're going to talk to, especially as you start getting into the 8-figure revenue range, are EBITDA buyers. And that's shocking to founders. It kind of dovetails with another lesson, which is nobody thinks your business is as valuable as you do. And so you might think your business is worth $100 million and you get out into the market, people are like, maybe 10, maybe 20. Because they're like, look, you're a team of 10 people. You spent 2 years building this thing. But if I was going to try to build it from scratch with $20 million, I could probably do it. So, or I could probably do it for $5 million. So what do you have? So you have to think, what leverage do you have? Your software is pretty easy to replicate. It's got to be some sort of asset that's very difficult. So you want to be thinking about when you're building your business, what are you building that would be extremely difficult to reproduce, whether it's network effects or some sort of technology that's like a deep tech or a user base or a proprietary data, something that would be really valuable to acquire, because if it's just software and a little bit of revenue, you're not going to get the valuation that you want. So you want to be thinking about that. And, I think ultimately it comes down to great businesses have great exits. So if you build a great business and, build a business that's defensible, that's growing rapidly, that
actually creates value,
is creating value and is unique and differentiated in a way that's defensible, and then you'll have a good exit. But you have to, build a great business. It can't be a mediocre business that's like a Me Too business or easily, reproduced with 10 million bucks, because then no one's going to buy you for 100 million if they could just go do it themselves for 10.
Exactly.
The other thing is, as you think about...
Before you go to the next thing, just to clarify, you said the types of buyers. You said there's technical buyers or technology buyers. What did you mean by that? Is that like strategics?
Yeah, that's like a strategic buyer where technology that you've developed is extremely difficult to reproduce, like some sort of like groundbreaking optical laser beam or something that's like useful for a multi-billion-dollar medical industry. Yeah. It's mainly an IP thing, and sometimes you might have patents on it, but a lot of times it's just like, wow, it would be really, really hard for us to build this from scratch. It would take a long time. Time's a factor too. Like if it would take a business 2 years to kind of catch up to your technology, because they say 9 pregnant women can't have a baby in 1 month. You can't just always throw money at a bunch of engineers and then make it happen faster. Sometimes a small group of engineers can move faster than like hundreds of engineers, because there's so much bureaucracy or whatever when you get to that scale. So if a company like Microsoft can save 2 years and they can get something out now and it can generate, $300 million a year in revenue for them, like right away, then they would buy it. So it's not always the cost, but it's also the time that it would take. Yeah, those technical and IP buyers, those are a lot of times the biggest acquisitions, like OpenAI. Microsoft didn't invest $20 billion in them for the revenue. They did it because it's like, holy crap, it would take us like 5 years to try to do this on our own.
Exactly. Awesome. Were there others, or were these the...
SPACs are dead.
Totally. That was fun while it lasted.
Pigs get slaughtered. This is something my dad used to say. Pigs get slaughtered. So as you're thinking about an exit, it's better to sell early than too early than too late. At some point, your business is going to plateau. As soon as your business plateaus, buyers become sharks and they smell blood in the water. And what you want to do is better to sell while you're on an upward trajectory and think, okay, yeah, I could probably get this business from 50 million to 100 million, but what happens if we get stuck at like 75 million? And then, so you'd actually get more money if you're growing at like 50% a year at 50 million revenue than at 75 million a year, but then you have a couple flat quarters. You're now going to be valued based on EBITDA instead of revenue growth. So,
Not what you want.
don't be too greedy. You want to sell. I would try to sell at between like 50 to 75% of where you're highly confident you could get the business from a revenue perspective, because what if you miss that and you flatten out, and once you hit that plateau, it's really, really, really hard to convince investors that you can turn the growth around.
It's absolutely true. That's newsletter worthy investorism right there.
Expect golden handcuffs. Start patenting things early. This is something that we did. We've already got 4 patents and we have 3 more pending. And that's helpful when you start having acquisition conversations with a company and they're like, well, why don't we just build this ourselves? And it's like, well, you're not going to be able to do a good job of that without violating this patent. Mm-hmm. If you can find a good patent attorney, if you find a good one that's like with a small firm, but just maybe has like been doing it for like 20 years, you can get a patent done for like $5,000-$6,000. If you're venture backed and you got a few $1,000,000 in the bank, you can have these guys get your patents done, and you can expedite them, because everyone thinks patents take 3 to 5 years. If you just paid $1,000 expedition fee, it's like 12 months, 12 to 18 months. Yep. At least have them pending so that when you start having these acquisition conversations, it's not only about the cost to reproduce what you're doing, but it's like, they actually couldn't build a competitive product without infringing on your patent.
Yeah, assuming you have something that's actually worth patenting and defensible, which...
Yeah, I mean, if you don't, you have to ask yourself, like, what are you building? I mean, you should be doing something that's novel. If you're not, I don't know how you would have raised VC. Debt's bad for exits. High burn is bad for exits. Build a business, not a financing round. So like I said, build a great business. Don't like I see a lot of companies make the huge mistake that they're focused on Series B. Like, let's say they raised $30 million in a Series A, and they're like, well, I'm going to go raise $100 million in my Series B. It's like, dude, you have $30 million. You should be able to get profitable with $30 million.
Yes.
You should be able to get profitable with $5 million.
Absolutely.
Build a business and then worry about financing. Stop thinking about your next round and creating this treadmill where you think you have to hire all these expensive people and burn the money. No, use that money to become profitable. Exactly. It makes your life so much easier in the future. So I say build a business, not a financing round.
Great
B2B
advice.
is valued much higher than B2C. We're a B2C business. It's much, much harder to raise money as a B2C business. I did it anyways because I'm a masochist, I guess.
No, it's because you really believe in what you're doing and it actually matters.
Believe in what we're doing.
Mission-driven business.
It helps actual people. Like, you can actually, there's a tangible benefit to individual consumers for what we're doing. And that makes me feel good about what we're doing. And, it's harder with business, like, oh yeah, we're an AI-powered HR SaaS solution. It's like, okay, great. Whose life have you impacted with that? Maybe you can make a lot of money doing that, and I'm sure that's a great business, but that's why I did that. Anyways, let's see. Don't get hung up on valuation or dilution too much. Positive outcome is going to be life-changing for you. Like, if you sell your company for $200 million and you own 25% instead of 30, are you really, is that going to affect your life that you made 50 million instead of 60 million? The difference is very nominal, and you might get really hung up in some round where you're like, well, I think we're worth 25, but they only want to invest at 22. It's like, dude, you are trying to build a business that's going to sell for hundreds of millions of dollars. Doesn't matter these little percentage points. Like, just, move on. people get they call it penny wise, pound foolish.
Exactly.
Another expression. There's some other things on here, but those are, I think,
Those are the big ones.
some good ones.
Yeah, I've seen a lot of exits to your point where it's like, maybe it was like a $50 million not clean deal, right?
Yeah.
Versus like a $47 million very clean deal. And they always,
Yeah.
everybody wants the 50 million. And it's like, yeah, there's so many factors you need to think about to make that decision. If that's really the right decision, usually it's not. If you have a clean deal versus a not clean, it's worth a lot more than, 3 million on a 50 million type of deal. So
Yep.
anyway, great advice. Well, this is awesome. I feel like I got to hear so many stories I didn't know, and I've gotten to know you so well over the last, 6 months, but this is now, there's even more pieces to the story and super helpful stuff too, I think. This is absolutely very informative and really tangible examples, so I think everybody will really appreciate this. So,
Cool. Those are
yeah.
just the exit stories. Next time we talk, we can.
I know.
mean, over the
Season
course
3, you're coming back.
20 years, 40 investments and 10 startups, you have lots and lots of stories. A lot of fun stories on the acquisition and growth side of things. There's user
Okay,
acquisitions.
cool. Okay. Well, we're going to have to do a part 2 to this for sure.
Yeah.
Well, thanks, Aaron. That's a wrap.